And yes, we're good to go. Satvik, you can start off.
Okay. Hi, guys. Thank you so much for joining in. Today's session is about fundamental analysis. And it's okay if you haven't heard that word before because we have Rohan Kishore with us. Rohan's a final year student from BITSCOA and he's an investment banking intern at JP Morgan and he's here to take our session. So without any further delay, I'm going to give it up to Rohan.
Hi, thank you for the introduction, Satvika. Hi, everyone. Great to see quite a lot of you here. I gave a short intro, but I'll just repeat myself. As Satvika said, I'm a final year student from BITSCOA. Currently interning at JP Morgan in my final semester, and I am from Bangalore, right now in Bangalore. We'll be going to Mumbai next week for the internship though. And yeah, about the session, guys, let's try to make it as interactive as possible. You guys have been pretty active on chat already, so that's great. Throughout the session, if you guys have any questions, please I'd rather prefer you guys unmute yourself because when I'm presenting my screen, I might not be able to see the chat. And just a heads up, during the session, I have a few questions for you guys as well. So when I do ask them, please unmute yourself because I probably won't be able to see the chat.
Rohan, they actually have turned off like a mute wala feature.
Okay.
So,
Okay.
I mean, Satvik can help you read the chat. Is it okay?
Sure, yeah, that sounds good. That's fine.
Yep. And I guess we can take questions in the last half of the session.
Yeah, that sounds good.
Okay.
Yeah. Okay, let's start off. Let me present my screen. Okay, before I start off, just to understand how much you guys already know, how many of you know what a stock is? If you guys could raise your hands. Okay, we have 14 raised hands until now. Is it safe to assume that the rest of you are not quite sure what it is? No worries, we'll cover that today. Cool. Got it. Now we can start off. So don't worry, whoever doesn't know what it is, I'll cover the basics today as well, and then we'll go into the details. Let me present my screen. Okay, Saksham, that's nice. Technical analysis is pretty advanced. Okay, let me know when you guys can see my screen.
We can see your screen.
Okay, great. Cool, then let's start off, guys. So this session, as you guys know, is about fundamental analysis. And before going into what fundamental analysis is, let's just do a quick overview of the different asset classes that people have to invest, right? If you guys start earning money later on, once you guys start working, or your parents are earning money right now, or you guys have multiple options to invest your money. It's not just the stock markets or not just bank deposits, etc. There are multiple asset classes. So before we go deeper into what a stock is and what fundamental analysis is, let's just do a brief overview of what asset classes are available to us. So starting off, the most simple and fundamental one, bank accounts. I'm sure everyone knows what a bank account is, and most of you might even be having one right now. Within bank accounts, there are different types of accounts depending on whether you're a company, whether you're an individual, or how frequently or how long you want to invest for. Current accounts are mostly for businesses because current accounts are where cash withdrawal is occurring on a very frequent basis, and businesses are those which require cash very regularly. And then we have savings accounts, which are mostly for us, like people like you and me. We have savings accounts in banks where we put, whatever salary we earn, we put it there, and the bank pays us an interest for that. And finally, we have fixed deposits, which are slightly more longer term. As you can see, savings accounts interest rates between 2.75 to 4, and fixed deposits from 3.25 to 5.75. So you can see that fixed deposit accounts have a higher interest rate, and that's because your money is locked in for a longer period of time. Moving to debt instruments, these are slightly more complicated. These, in a way, are similar to loans. So let's say the government wants to borrow some money. You can loan that money to the government, and the government will pay you certain interest on that. So the government of India issues such bonds regularly, and it's probably one of the most safest instrument in our country because it's government backed. And as we know, the government barely ever default, right? Because they have a lot of resources behind them. Similar to government bonds, we have corporate bonds as well, which are almost same as government bonds, but they're issued by companies like you guys know Reliance, Infosys, TCS. So when they want to raise money, taking loan from the bank isn't the only option. They can borrow from people like you and me as well. So that's when they issue corporate bonds, and we pay the company the money they require, and we earn interest on that. Then coming to alternative classes, this is probably the most exciting one for Indians. We have gold and real estate here, which are traditionally the most favored ones for Indians. I'm sure everyone knows what these are and how they work. But why would gold? Obviously, jewelry is one option, but why else would you invest in gold? Because gold is the most safest asset in the world, right? Obviously, apart from I'd say currently right at the top is US dollar, which is probably the most safest. Along with that is gold. Why is gold such a safe asset? One, because it's a universal commodity, right? It's not just localized to one country or one region. It's accepted throughout the world, and it's rare. Second reason it's rare, because gold is not in abundance. You can't just dig under your house and find gold, right? Because it's rare, it has a certain value associated with it. And that's one reason why people, especially during recessions, if you guys know about the 2008 financial crisis, or even at the onset of COVID, when markets were not looking great and people were skeptical about the future, the gold prices started going up. That was because a lot of people started investing in gold. Because as we know, at the start of COVID, the stock markets crashed and people were losing a lot of money. But gold is a safer bet in such cases, because be it COVID, be it war, like what's happening right now, the value of gold remains the same, right? It's not the war or the COVID crisis is not affecting gold as a commodity. So that's why gold is one of the safest classes. And real estate also, you guys know, that's the most longest term investment, if you can call it. Um, Land, properties, buildings, everything comes under real estate. Even if you have a apartment that you own and you're renting it out, that is also considered as real estate income. So this is another traditional class which most Indians and most people across the world naturally have invested in, because we obviously need some place to stay, and that naturally becomes an investment as well, because the value can appreciate going forward. Now, finally, coming to the most interesting class and what this session is all about, that is equity. So what exactly is equity, right? What is a stock? What is equity? Equity is portions of a company which are given out to investors like you and me. So as I mentioned, if a company wants to raise money, they have bank loans, then we have bonds, right? These are the two things we saw already. The third one is equity, where the main difference between debt and equity is, in debt, when you give money to a company, they will pay you a fixed interest rate every year. So let's say I loan 100 rupees to Infosys, and they say that they'll pay me 5% every year. So every year they give me 5 rupees, because that's 5% of 100. But in equity, there's no fixed income that the company gives you, right? It's the extra risk that you're taking. But the other advantage of equity is that you get a portion of the company. So let's say you buy one share of Asian Paints. That means you own 1 billionth of Asian Paints, right? One share is worth one billionth of Asian Paints. So what happens when you get this control or this ownership in the company? Obviously, you become a part owner, but you're not a big enough owner to directly make decisions, right? Because there are billions of people who own Asian Paints shares. So what you get is a voting right. So when a company usually has to take a decision, they open up voting for all the shareholders. So if I own one share of Asian Paints, whenever a company is making a big decision in a board meeting, I get a mail saying the voting is open, and I can go vote for whatever outcome I want. So that's how they can mobilize the opinion of all the shareholders. And this is the biggest advantage you get while holding a stock, because you get direct ownership in the company. Now, why would someone invest in equity apart from just having, a say in um, or having a vote in what the company does? So there are two main reasons. Obviously, people invest money to grow it, right? It's an investment class. Also, I see a few messages in the chat. I'll take them after a while, after I finish this section. So yeah, coming to why people would buy shares, it's obviously to make money, right? We all invest money or invest our hard-earned money to grow it. And how will owning a share make us richer or give us more money? There are two ways you can make money once you have a share. One is through dividends. We'll cover this later in detail, but basically what a dividend is that when a company, let's say, has a good year. For example, over the last couple of years, Zoom as a company has done really well because of everything moving virtual and a lot of people adopting Zoom. So what Zoom can say is people have trusted Zoom from years, right? Some investors have been with Zoom from 2015, 2016. And to pay back to them for the trust that they've had in the company, Zoom can say that, okay, today this year has been good for us. We have a lot of extra money with us. We'll give out some of that to you guys because you guys have stuck with us right from the early days. So that is what a dividend is. It's basically a discretionary payment where a company says thank you to its investors and gives back some of the money to the investor. For example, in India, if you guys know ITC, it's one of the stocks which pays good amounts of dividends. And if I own, let's say, a stock of ITC, every year the company usually gives out some amount as dividend. Could be 4 or 5 rupees per share, but some amount of dividend is given out by the company. Just give me 1 second. Yeah. So what is the second way to make money, right? Dividends, okay, is one way, but not all stocks give dividends. Not all companies decide to do this because not all of them, have this in their financial policy. The second and the most common way to make money is through capital gains. And what capital gains means is the best analogy for this is, let's say, so basically when you own a stock, it's a store of value, right? The stock certificate itself is worth nothing unless and until someone buys that from you. It's very similar to, let's say, having a 10 rupee note in your pocket right now. You can go give it to the government. Just having a 10 rupee paper doesn't really say anything unless someone gives you something which is worth as much, right? If I go to a shopkeeper, then he gives me something which is worth 10 rupees. That's when the note actually has value. Otherwise, it's just a piece of paper where, it barely has any value. So similarly, a stock gets its value because of what others are ready to give you for that stock. And that's why you need people to buy that stock from you. And that's where the stock markets come into picture. So when I have a stock, let's say I have one stock of Asian Paints, just having it doesn't really give me any sense of value, right? For example, if you say Elon Musk's net worth is 1 billion, it's in paper. He doesn't really have that 1 billion in cash with him. Unless someone buys out Tesla from him, he won't get that 1 million. It's just in paper right now. Similarly, if I own a stock of Asian Paints, let's say it's worth 1,000 rupees, it's just virtually worth 1,000. I won't get that 1,000 in cash unless someone buys it from me. So that's where stock markets come into picture. Stock markets you can think of as like a big marketplace where people can buy and sell shares. And that's the most important aspect because if you can't sell your share, as I said, the value is only going to be on paper and you're never going to realize that value. So now moving to why stock prices move. So you guys might have seen multiple TV channels on newspapers, different websites where stock prices are moving every second. But the only people involved in stock markets are people like us, right? Me, you, big investment banks who trade stocks. How can we influence the stock price? So stock prices mostly are driven by information, right? So when we get positive information from the company or negative information from the company, that's when stock prices move. And information can be of two types, positive or negative. Starting with positive, as the example I mentioned, suppose Infosys is having some problem with their CEO, and they all collectively decide to, let go of the current CEO and appoint a new CEO. So this is mostly a positive sentiment because the existing CEO was having problems. He wasn't doing well for the company, and a change there could mean Infosys will start to do better in the future. So that is a positive information which has come through news, right? Infosys either can directly release this or a media company like Times Now, Republic can release this. And we as investors, when we find this information out that, okay, Infosys is changing its CEO, that's when we want to buy Infosys stock, right? Because now we know the new CEO might make changes and might, create value in the future. So we want to buy Infosys stock. So that's when we go to the market, and because the demand for the stock is higher, the price of the stock will increase. And similarly, on the negative side, let's say there's a big crash for Jet Airways midair. And that is very, very bad news, right? Because of two reasons. One, it could mean that there's a technical problem with all of their flights, the entire fleet. And that's a very big issue for Jet Airways. Second is it's a negative publicity, right? If you know that a particular airline's flight has crashed recently, you would be more skeptical about, flying with that airline in the future. So that could reduce, their customer base going forward. So that's a very negative news for Jet Airways. And obviously, once people find that out, once the news breaks out that, okay, our Jet Airways plane has crashed, people will want to sell their share because they don't see, Jet Airways doing so well in the future. So that will drive stock prices down because a lot of people want to sell the stock. So this is the basics about how stock prices move and what happens. I'll just go to the chat for a second. Okay. Why when stock market crash and gold value increases? Yeah, that's a good question, Shivam. So as I mentioned, gold is a safe haven, right? Because its value is not really affected by a COVID, let's say a COVID crisis. How COVID affected companies is because of the lockdowns, companies couldn't really sell their products directly to consumers anymore. So that directly impacted their businesses, which is why stock prices fell down. But gold, on the other hand, wasn't affected in any way, right? The gold value, the supply demand of gold has remained the same. Yes, you could say that the jewelry businesses could have taken a hit because of lockdowns, but gold as a commodity hasn't changed, right? It's still the same, it still has the same shine, same fundamentals and everything. So gold will not lose value because it's not getting affected negatively in any way. So that's why during financial crisis or the COVID situation, the price of gold usually stays stable and in fact might even go up because a lot of people are shifting to gold. So that's why during stock market crashes you usually see gold prices going up because people remove their money from stock markets and put it into gold. So that drives the price of gold up. Oops. Yeah. Yeah, Sakshan, that's a good point. Real estate, you can't invest small amounts, right? That's why, stock markets have gained so much traction because you can invest even amount as small as 10 rupees if a stock is that small. Cool, let's move on, guys. We'll take questions later on as well. So now I have a small exercise for you guys. So there is some scenarios that I've described, and I want you guys to tell me which direction the stock price will move given the scenario. So the first one, as you know, Kerala is the largest rubber producer in India. I don't know the exact percentage, but most of the rubber in India comes from Kerala. So let's say Kerala has, severe floods and the cultivation of rubber is destroyed. What impact could this have on the stock price of MRF, which manufactures tires using this rubber? Type answers in the chat, guys. Great, great. That's right. Downtrend is the right answer. Could anyone tell me why? Why would it be a negative impact? Perfect, perfect. Naisha, that's the right answer. Because the supply of rubber decreases, the cost of rubber will increase, and rubber is the raw material for MRF. So because the costs increase, the profitability will reduce and the company won't perform as well. Coming to the next one, this is pretty interesting. Let's say the global warming is expected to accelerate over the next couple of years. What do you think would be the effect on the stock price of Vadilal? Um, I'm guessing most of you know Vadilal. It's an ice cream company. Okay, we have both sides of answers here. That's interesting. So whoever said it'll go down, could you please tell me why would it go down? What is your reasoning? And likewise for whoever said up as well, because company has to invest more to the freezing tech. Okay, that's an interesting point. Government sanction. Okay, I'm not sure what exactly government sanction means in this case. Josh, if you could just explain that. Demand increases, exactly right. So if temperatures start increasing, people would start craving ice creams more and the demand for ice creams would increase. Saksham mentions a good point. They might have to invest more in freezing tech, but that wouldn't be as much, that would be clearly offset by the demand increase. Because you look how many customers would, start wanting ice creams more, and the freezing tech already is strong enough to handle, 1 or 2 degrees increase in temperature. So good guys. Finally, third one, this is slightly tricky. So I want you guys to think critically about this. So let's say there's a burial service company, right? Which, let's say, manufactures coffins. And this company wants to sell their company to someone else, basically wants to get acquired. And I want you guys to figure out which industry or companies from which industry would be really interested in acquiring this burial services company. Right? And just a small hint, you guys can think along the lines of how owning a burial service business could help, certain companies avoid risks or would create synergies with their existing business. Burial basically means, after one has deceased, how you bury them. You could just take an example of a coffin manufacturer in this case. Okay, healthcare, I see a lot of healthcare. Real estate, interesting. Insurance, excellent. I mean, there are multiple answers, but if you guys could, maybe write a small description of why you think a particular industry would be interested, especially those who said insurance, healthcare, and real estate. Byju's, wow, interesting, Niladri. I think you should reach out to Baiju Ravindran for this. Please let him know your ideas for the company. Okay, guys, could you guys tell me whoever said healthcare, insurance, real estate, what's their reasoning? I'm particularly interested in those who mentioned insurance. Right, rapid, good point. Real estate because of graveyards, that's a good point, Saksham. That would create a lot of synergy in terms of they wouldn't have to acquire new land for the burials and they already would have real estate. Right. So good answers, guys. I think I'm not sure why people said healthcare. It would be great to get an explanation from that point of view as well. But real estate is an interesting answer. And the answer I had in mind, obviously, is not the only one, was insurance. And the reason for this is because usually insurance companies are in the business of, let's say, life insurance, right? They have to pay out money to the people when someone dies, right, to their families. As long as someone is alive, they earn money through premiums. But as long as someone, is deceased, they have to pay out huge sums of money to the families. But owning a burial service company would, in a way, offset that risk, right? Because when someone is deceased, they can then earn money from the burial services. By providing those services, they earn money. So that kind of offsets the amount they need to pay out to the family, obviously by a small amount, but it's kind of a hedge to their risk, right? Because whenever someone is deceased, now not only they are giving out money, they're also earning money through the burial service. So in a way that reduces the risk when someone is deceased. So yeah, I mean, it's a marginal benefit, but it is a hedge to their existing business. Cool. Moving on to the next part, which is the fundamentals of the company, which is what we are here for today. Right. So what exactly are fundamentals, right? Fundamentals are broadly divided into two aspects, quantitative and qualitative. This is one way to, separate the fundamentals. And there's another way, which is internal and external factors. So every business, as you guys know, has certain intrinsic factors which would affect the business. That is the capital structure, the management they have, the kind of staff they hire, what business, what industry they're in. But apart from this, a very important segment is the external segment, where the government rules, regulations, the environment, tax rates, foreign investments into the company, all of these are external factors that the company by itself can't control. But they have a very, very big impact on how the company can perform moving forward, right? For example, if you look at the tax rates itself, if the government raises corporate tax rates, the company has to pay out a lot more money in taxes, and that could affect the profitability of the company. And an even bigger rule change from the government. Let's say the government bans the sale of cigarettes in the future because of global warming or whatever reason, that could severely impact cigarette manufacturers like ITC, right? ITC gets most of its money from cigarettes. But if there's a rule saying cigarette sales have to be banned, that's a very big loss for ITC. Similarly, now moving to the next distinction, which is quantitative versus qualitative. This comes under the internal factors. So quantitative is the financials, so which we'll be diving deeper into as we move along. So the revenues, expenditures, dividends, the assets a company has, the loans the company takes. Then the qualitative aspects like who the management of the company is, what are the employee skill levels, what structure they're maintaining in the organization, what industry they're in, what is the future of the industry looking like. For example, if you look at EVs, electronic vehicles, that's an industry which is, which is set up well to have a very good next 5 to 10 years. So all these things, but on the other hand, if you have oil and gas, with renewable energy sources becoming more popular, oil and gas might not have a very bright future 20, 30 years down the line. So these qualitative aspects do impact a company. And as investors, we need to, make sure we are looking at all of these. So these are the fundamentals of the company. Now, moving deeper into the quantitative side, which is where most of the fundamental analysis takes place, not to take away from the fact that, the qualitative aspects that I just mentioned, they're not less important. Those are something we need to look into as well. But the only issue there is it's very subjective, right? Because an industry which I feel will do well in the future, you guys might not think the same way. But quantitative figures are facts, right? These are things published by the company itself. These numbers are what we have and we know are true. So analyzing these would give us, concrete information about what can happen in the future. And most of the information that anyone would require to make investments in a company as retail investors like me and you would be found in the annual report of the company. And an annual report is basically every company that is listed on a stock exchange is required to publish that annual report every year. And in that report, there are different financial statements which they include, and these have all the information, that we require. And even beyond the financial statements, there are a lot more information that the company, publishes in these reports. And trust me, guys, if you guys try to read an annual report from page 1, you guys will probably give up in page 3 itself. That is how detailed they are, and that's how much information, there is in annual reports. So moving on to what are the important parts of an annual report, right? What are the important elements that we need to look for as investors? And just a clarification for you guys. Think of this entire part of the session from now until when we end from an investor's point of view, because we are the ones performing fundamental analysis. We want to know whether this company is a right one to invest in. So think of it from an investor's point of view. So what are the information we would need to make an investment in a company? Starting off, we want to know what the major stakeholders in the company think, right? Like the CEO, chairman, CFO, what are their views on the company, what they think will happen in the future, because they are the ones who have the most information about the company, because they're working in the company, they obviously know much more than we do. So in the annual report, there's a section called Management Discussion and Analysis, where the chairman, CEO, they chart out what the path of the company could look like in the coming few years. Then we have the financial statements, which are probably the most important ones for us. Within this, we have balance sheet, income statement, and cash flow. We'll cover this in detail going forward. Then we have the notes to financial statements. These are part of financial statements itself, but they're mentioned separately and they go much deeper into what each line item within the financial statements mean. So let's start off with balance sheet. I'll just check the chat once. Can teens invest in stocks? As long as you have, a bank account, you should be able to invest in stocks. And I think the threshold for that is 18 years old. But I mean, apart from that, also you can, work with your parents to invest. Once you have the basic knowledge of fundamentals, how and where should one learn further? Like what courses? Okay, we could take this up in the end, Rohit. I'll go into that towards the end. Cool. Coming back to what a balance sheet means. So any company has three different elements. Okay. Those are assets, liabilities, and equity. Let's dive deeper into what each of these means. Starting off with assets. Basically, what an asset means is any resource or any investment which could generate returns or be of potential use in the future is called an asset. So one example which would come, immediately to all of your minds is real estate, right? We have covered it. So if any company has a manufacturing facility on a piece of land, that land is something the company owns and they can sell in the future and convert it to cash. So this is something which can give the company good returns in the future. So it's a resource which could, benefit the company in the future, and hence it would come under assets. So basically, this is how you can think of assets, anything which has the capacity to generate return in the future. Now, within assets, there are two types, current and non-current assets. So as the name suggests, current assets are those which have the ability to generate returns in a very short period of time. Usually the defined period is 1 year. So within 1 year, they'll be able to generate returns. And on the other hand, non-current are those which require a longer time. For example, the example we took of, real estate, that usually companies hold for a longer period of time. And even if you want to sell real estate, to find a buyer, it takes, considerable amount of time. So these are non-current assets. Giving you an example of current assets is, let's say if the company has invested, some amount of money in the stocks of another company, let's say a subsidiary. So this is something which they can directly sell in the stock markets and, realize as cash immediately, right? Whenever they feel like selling it, they can sell it and they'll have cash within a day or two. So these are current assets, which, they can realize very quickly. So this was a brief overview of what assets are. Moving on to liabilities. So liabilities are obligations that the company has to fulfill at some point in the future. So how you can think of liabilities is that basically the ball is in the company's court, right? So if someone else has done their part of the duty and it's the company's turn to repay it now, that's what, gets classified as a liability. We'll look at examples in the next slide, but you can basically think of it as anything where the company has to return the favor. That's, that comes under liabilities. And again, similar to assets, there are two types, current and non-current. Same meaning. If a company has taken a long-term, loan from a bank, that's a liability, right? Because they have got the money now, but they need to repay it at a future point. So that's an obligation that the company has to return to the bank. So that comes under liabilities. And because, loans are usually longer term, it comes under non-current. There could be short-term loans as well that would come under current, but let's, leave that aside for now. Right now, I have a small exercise for you guys. And while going through these, just keep in mind the definition I gave you for liabilities. Anything where the company owes something or has to return the favor to someone, that would fall under liability. Right. So let's go through these one by one. And guys, reply on chat. So starting off with the first one, let's say a customer pays the company or pays you 50,000 rupees for a phone, but you haven't given the customer the phone yet. Would this be a liability for you or not? Okay, Okay, we have mixed responses here. Could you guys tell me the reasoning as to why yes or why no? Okay, because he has already paid for it. Okay, right. So the answer is yes, guys. It is a liability because the company has got the cash, right? The customer has paid the cash to the company, but the company hasn't given the phone yet to the customer. So the company still has to return the favor by giving the customer a phone. So this does come under liability for the company. So as I mentioned, moving on as well for the remaining parts, please keep in mind that anything where the company has to owe something to someone or has to return the favor would be classified as a liability. Okay, coming to the second one, you deliver the phone to your customer, but he will pay you in EMIs going forward. Would this be a liability for you or not? Awesome. So all of you are getting this right. The answer is no, it's not a liability because you have done your part, right? You have to give the phone to the customer, you have done that. There's nothing else left for you to do. The customer is the one who has to give you cash. So it's not a liability for you, it's in fact an asset for you because you've given the phone to the customer, it's generating future revenue for you in terms of EMIs. So this is not a liability. We go on to the third one. Let's say a company who's manufacturing phones has a delivery agency which delivers the phones. You pay the delivery agency 200 rupees for a delivery, but they haven't delivered your phone yet. Would this be a liability for you or not? Okay, I see a couple of yeses. Could you guys tell me why you think it's a yes? Okay. Right. So most of you got it right. It's not a liability because again, you have done your part of paying the delivery agency, right? They asked for 200 for the delivery. You have given them the 200. Now it's up to them to deliver the phone to the customer. There's nothing for you to do. You don't have to return any favors. In fact, you have already done your part. So this is not a liability for you. Moving on to the third one. You buy 15,000 worth of raw materials from a supplier and the supplier sends you the materials, but you tell him that you will pay him 1 month later. Would this be a liability for you or not? Excellent. I think everyone's getting this right. Yes, it would be a liability because you still have to do your part, right? Which is paying for the raw materials. Okay, moving on to the next one. Let's say the government says you need to pay 1.5 crores in tax to the government, but as of now, you've paid only 1 crore. Is there a liability for you here or no? Great. I think a lot of you are catching on now. Yes, it is a liability for you because you still need to pay the remaining 50 lakhs to the government. That is something you have to do on your part. So it does, count as a liability. Oops, sorry. Yeah. So the final one, let's say it's the end of the month and you need to pay, salaries to your employees and you pay your employees salary of 10 lakh for their work over the last month. Is this a liability for you or no? Okay, I see a few yeses. Mostly no's. Okay, this is slightly tricky, but just pay attention to the fact that you have already paid the 10 lakh and the work is also completed over the last month. Yeah, Rohit, forget the current month. Just imagine that it's the last day of the month and you're paying your employees. Cool. I think most of you got this right as well. It's not going to be a liability because before paying the 10 lakh, yes, it definitely would have been a liability because your employees have worked for you, but you haven't paid them yet. But now, since you have made the payment, it's no longer a liability for you. You don't really have to do anything from your side further to, reward the employees. You've already paid them. So it's no longer a liability for you. So that was it. Let's move on now. Yeah, there's a bit of grammar involved there. Anyway, now, yeah, this is the split of the different types of assets and liabilities. So within current assets, you have cash. Obviously, cash is the shortest form of asset, right? If I have cash right now, I can convert it to anything whenever I want. So that's obviously comes under current assets because it takes me less than a minute to convert cash to anything else that I want. And non-current assets, PP&E mostly, as the full form is plant, property, and equipment. This includes the machinery a company might have, the land, the building, etc. And intangible assets. So intangible assets, I think the best example you could think of is a patent, right? So if let's say there's a drug manufacturer, a pharma company, which has found a secret formula to, let's say, curing COVID forever. And they obviously wouldn't want to give this out to everyone, right? Because a lot of research has gone into this and they want to keep this to themselves. So that's what they apply for a patent and they get it. And obviously, a patent isn't a physical asset, right? It's not something that you can see or touch or feel. It's just, a certificate or something which says no one else can use the same formula. So that's an intangible asset. And similarly, on the liability side, don't worry about what each of these mean: accounts payables, accrued expenses. These are something which you will probably learn at a more advanced level. But just on the non-current side, if you can see long-term debt, that's the most important part of liabilities. Right. Moving on to the next part, which is equity. This is where we as investors come in, right? This is the amount of money we give the company or the founders put in themselves. So within equity, there are 4 types. First is the share capital, equity share capital. So when a company decides to go public or starts an IPO, their shares are intrinsically, let's say, they say the par value of the share is 10 rupees, right? Usually this is the face value that companies keep for their shares, 10 rupees. And let's say they sell 100 shares to the market. So the face value 10 into the 100, that's 1,000, that is the equity share capital. But what usually happens during IPOs is, because so many people are interested in investing in the company, they don't just pay the 10 rupees, they usually pay a premium. I could say that, oh, this is a very interesting company, I really want to own it. So I'll give the company 12 rupees instead of 10. So the 2 rupees extra that the company is getting from me, that goes into the securities premium reserve, because that is something which they're getting a premium over the face value that, they're trying to get. So that's the security premium reserve. Then the capital reserve, capital. So whenever you guys see the word capital in a finance context, think of, big investments. So usually capital investments or capital expenditures is the amount of money you spend on buying, let's say, a new manufacturing unit or a new machine or a new car. So capital reserve is the amount of money the company saves for long-term projects. So if they have to, let's say we're talking about an infrastructure company that builds bridges. So the amount of money they would save to build a bridge in the future, that would go into capital reserve. And finally, general reserve. So let's take the case of, let's say, Tata Motors. If they have been in the, selling vehicles business for years now. So whatever the profits they make every year from selling their vehicles, that goes into the general reserve account. So these are the 4 different types of equity accounts. You guys don't need to know the details of each, but these are the broadly 4 different categories. And coming to the accounting equation, please remember this carefully. This is the most important equation in financial analysis, right? Assets is equal to liabilities plus equity. So how this holds true, let's take an example to solve this. Let's say there's a company which has 100 rupees worth of assets, which is split as 15 liabilities and 15 equity. And now the company takes 25 rupees of loan from a bank. And as we have discussed before, a loan is a liability, right? Because the company has to pay it back in the future. But this loan doesn't really affect the equity in any way. So the equity remains 50, but the liabilities now has gone from 50 to 75. So on the right hand side of the equations, we have 75 plus 50, 125. But on the left side, we had 100 before, but the 25 isn't reflecting yet, right? And there's a mismatch here. So where do you guys think the 25 is missing on the asset side? How will taking a loan potentially increase the LHS as well by 25? Did you guys get the question? And if yes, okay, no. Okay, so let's go back, right? So starting off, a company has 100 rupees worth of assets, 50 rupees of it is liabilities and 50 is equity. So right now, left and right hand side are matching. But now the company takes 25 rupees loan, and that is increased the liabilities by 25, but there's no change yet on the asset side. Where do you think this mismatch lies? Right, Ritik Lokendra, that's the right answer. Because once a company takes loan from the bank gives the company cash, right? And cash, as I told you guys, is a short-term asset. So the 25 rupees they get in cash would increase the asset side by 25, and then the equation would balance itself out. So that was just a small example for you guys to understand the equation. But it's good to know this. It's the most fundamental aspect, but you don't really use this when analyzing a company. So let's move on to the more useful aspects per se. Right. So this is a chart which tells you how the daily operations of a company can impact its equity. So if you guys remember, a couple of minutes back, I told you that the profits generated from the business end up in the general reserve account under equity. So let's track the journey, right, from the revenue all the way to how it ends up in equity. So start right at the bottom where we have revenues minus expenses. This is fairly straightforward. Company gets a certain amount of revenue, but for that they have a certain amount of expenditure and they end up with a net income or net profit. So from this, as I again mentioned earlier in the discussion, they pay out dividends, right? Some companies want to reward their investors for being loyal to them. So they pay out dividends. And that obviously gets deducted from the net income of the company. So now this would be called retained earnings. So this is the earnings that the company has got throughout the year after deducting dividends that they've given back to the shareholders. Because once they're given back, they no longer have that cash, right? So what's remaining is called retained earnings. And in addition to this, we have capital contributions. So let's say I'm the founder of a certain company and I feel like this is the right time to invest more into the company and I want to contribute 100, let's say 1 crore to the company. So that also goes into equity, right? Because the company is not liable to pay me anything. And because I'm the founder and I'm investing more money, I'll obviously get stake in the company. So that goes to the equity side. So this capital contribution from the founders plus the retained earnings from the yearly business operations get added up and go into equity. And again, you guys might be wondering, how does the equation balance itself out? So again, it's cash, right? Cash is mostly the answer to how it balances itself out. Because you have sold certain amount of goods, you have some cash with you, and that cash increases the asset side. So the equation eventually gets balanced. Now moving on to the second. So right till here, we were at the balance sheet. Balance sheet, basically another point for you guys. The balance sheet is at a point in time. So at the end of the year, let's say a company releases its financial statements on 31st March. At that point, on 31st March, 12 a.m., what are the assets, liabilities, and equity a company has? That is what is reflected in a balance sheet. Coming to P&L statement, this is more, throughout the year. So this shows the revenues and expenses that the company has generated throughout the entire year. And it's not just, a point in time, it's throughout the course of the year what the company has earned. Also, guys, could you just tell me if you feel I'm going fast or slow? I'll change my pace accordingly. Just let me know in the chat. Okay, moving on. Within revenue, right? Revenue is what the company is earning. Okay, fast, all good. Okay, I'll go slightly slower maybe or maintain the pace. Cool. So Coming to revenue, we have two types. One is operating revenue and non-operating revenue. Operating revenue, as the name suggests, is the revenue a company earns from its daily operations. So, let's take example of Tata Motors, right? So Tata Motors is primarily involved in the business of selling cars. So the amount of money or revenue Tata Motors earns from selling vehicles alone is what is called operating revenue. But Tata Motors could have other sources of revenue as well. So they might have invested in, let's say now Tata Motors is moving, pretty strongly into the electric vehicle side. So if they acquire a smaller company, which is, producing, let's say, batteries for EVs, that is not a direct income to Tata Motors, right? It's not coming from the core operations of selling cars. That is coming from one of the investments they've made. So that the revenue from that company which they acquire would come under non-operating revenue. So these are the two broad types of revenue, and you won't see further classification on the financial statements. So this is good enough for now. Moving to expenses. Expenses could be anything, right? There are so many different types of expenses. We'll look at the chart in the next slide. But broadly, you can think of operating expenses, which are mostly raw materials and directly contribute to the operations of the company. Then we have the interest rates a firm might pay for the loans they've taken, then the salaries they pay. So all these come under different buckets, which we'll see in the next slide. So here, the five line bullet points that I've highlighted in green are very important, and you guys need to remember these in the order, right? Initially, it might feel like you have to by heart it, but please don't think of it that way. As you read more balance sheets, read more financial statements, this flow will automatically come for you guys. So starting off with the gross profit. So again, going back to the Tata Motors example, let's say they've sold 2 cars throughout the year, each worth 20 lakhs. So the total revenue is 40 lakhs, and let's say they spent 10 lakhs per car, for all the raw materials and other costs, other costs which directly go into the car, like buying the metal for the car, buying the rubber for the tires, the raw materials, other raw materials involved like plastics, electronics, etc. So that would give us 40 lakh minus 20 lakh, a 20 lakh gross profit, right? After gross profit, then we move on to the EBITDA, which is earnings before interest, tax, depreciation, and amortization. So depreciation and amortization is a slightly advanced concept, but to tell it to you guys in a minute, it basically would be, if I buy a machine which I can use for 5 years, I'll obviously shell out the entire money this year, right? If it's worth 1 crore, I'll be paying the entire 1 crore right now. But I'll be using the machine every year for the 5 years going forward. So it wouldn't be fair to just say that I spend the entire 1 crore now, but the machine is going to be used throughout the next few years. So what I do is every year I show 20 lakhs of expenditure. So I pay 20 this year, 20 next year, 20 in the third year, and so on. So that the sum comes up to 1 crore, and it's more fair because I'm using the machine in all the 5 years. So that is what is depreciation. Amortization is the exact same thing, but for intangible assets like patents, etc. So once you subtract these expenses, you get the earnings before interest and tax. So, right, sorry, earnings before. So DNA was where you get subtracted now. Moving back to EBITDA. So once you get the gross profit, which is 20 lakhs in our case, you then have to pay out salaries to your employees, right? Salaries, the other operating charges that you have for maintaining the offices, customer call center, service stations, etc. So all these, once you subtract from the gross profit, you get the EBITDA, earnings before interest, tax, DNA. And then from this EBITDA, if you subtract the depreciation and amortization that I just mentioned to you guys, you get the EBIT. And EBIT is basically earnings before interest and tax. So as the name suggests, it's the amount of earnings that you have before you pay out interest and tax to the government. So interest is basically for any loan that you have taken, the amount of interest you have to keep paying the bank or the customer or whoever has lent you the money. That is what is interest. So once you remove interest from the EBIT, you get PBT, which is profit before tax. Again, this is very intuitive from the name, right? It's the profit you have before you pay tax to the government. So once you pay the tax, you end up with PAT, which is profit after tax. This is also called as net income. Excuse me. So this is the final earnings that you have for the year. And this might seem like a lot of info to take in now, but maybe you can share the slides with you post the session, and you guys can, go through these 5 line items again and try to understand what each of them means and how they flow from top to bottom. Now coming to the third statement, which is cash flow statement. So in financial accounting, one very important thing you guys need to keep in mind is a transaction is recorded not when the cash switch happens, but when the exchange of the item happens. So for example, when Tata Motors is selling a car, so when the agreement is reached between Tata Motors and the consumer that the consumer wants to buy a car, that's when you record that, okay, I've sold a car for 20 lakhs. The cash might not have come into your accounts yet, but still you record a revenue of rupees 20 lakh. That's how financial accounting works, and this is called the accrual accounting concept. So it's not when the cash transaction happens, but it's when the actual agreement happens. And cash flows, and obviously that could be misleading at sometimes, right? Because a company could, have recorded huge amounts of revenue, crores of revenue, but they haven't got any cash into the business. So that gives a false picture when you look at the statement, right? When you see, okay, 1 crore revenue, you might think, well, the company is doing excellent. It has a lot of cash reserves. It will survive over the next few years. But what if there is no cash transaction that has happened? So that's where the cash flow statement comes into picture. So a cash flow statement clearly tells you guys about what cash transactions have happened throughout the year. And within cash flow statement, there are 3 types: operating, investing, and financing. Uh, as the name suggests, operating means regular operations of the company. Buying for Tata Motors, it would be selling cars, buying raw materials. These are the direct operations. Then you have investing activities, which is basically when you buy something for a long term. That's an investment, right? So if you're spending cash on that or gain cash from that, that is investing. Finally, financing activities, you could broadly think of 2 things. One is debt. When you take a loan, that's a financing activity, right? Because you're raising money. And second is paying out dividends. This is a very important aspect. When you pay dividends, it's considered as a financing activity because um, it's not something which is going to give you returns in the long term. I mean, yes, you could say that people will start investing in you for the dividends, but it's not something which will give you solid returns in the future, and it's not even an operating activity, right? It's not the core business. Tata Motors doesn't exist to pay dividends to people, right? It exists to sell cars. So dividends comes under financing activities because it's related to the equity portion. Whoever owns a stock gets the dividend. So let's do a quick activity here again. Let's classify all of these into operating, investing, or financing cash flows. So starting off with the first one, the company takes a loan of 1 lakh rupees. Which one would it be? Operating, investing, or financing? Okay, operating. Anyone else? Operating. Financing. Yeah, financing is the right answer, guys, because as I mentioned, it's a loan the company is taking. So it's a way of raising money or raising finances. And just think of it this way, right? When you're saying something is operating, think, does the company exist to do this? Does Tata Motors exist to take loans? No, right? It exists to make and sell cars. So it doesn't come under operating, it comes under financing. Second, let's go to company sells phones worth 10 crore. Let's say Apple sells phones worth rupees 10 crore and earns the money in cash. Which would this come under? Operating, perfect. So because it's the core business of Apple, right? Apple exists to sell phones. So this comes under operating. Third, company gets a patent on its mobile design. Let's say Apple has a new design that, could make phones more sleeker, and they get a patent on it, which will allow them to generate revenue in the future. What would this be? This is a slightly tricky question. Think of what I mentioned. What does cash flow really indicate? It's the cash transactions that happen. So what do you guys think about the third point? I see a lot of investing. Fair, I can understand where that is coming from, but this is not a cash flow transaction at all, right? There is no cash exchange happening right now. Company is just getting a patent which will allow them to generate revenue in the future. They haven't spent anything on the patent yet. Maybe there's a small charges on registering the patent, but they haven't spent anything yet. So because there's no cash transaction that has happened right now, it doesn't come under cash flows at all. So it won't be in either of operating, investing, or financing. It's a non-cash item. Okay, let's move on to the next one. So this third one might be a tricky one, but because there's no cash transaction involved, it won't come under the cash flow statement. Okay, fourth one, company sells its existing manufacturing facility for 100 crores. What would this be? Let's say the company is, again, Apple. It has a phone manufacturing facility in San Francisco, which they're selling. Operating, financing. Okay, the answer to this is actually investing. So again, buying and selling manufacturing facilities is not the core business of Apple, right? They don't exist to buy or sell manufacturing units. So this definitely wouldn't come under operating. And usually when we say manufacturing facilities or land, etc., these are long-term assets that the company has. So any transaction involving such long-term assets would come under investing, because it's not something which has happened immediately. It's something that you've held for a long time and you're selling right now. So this is an investing cash flow. These might be difficult right now, but as you guys, read cash flow statements and go through each different section, you guys will get used to it further. And finally, dividends. We have covered this in the last, I explained this in the last slide as well. Yes, dividend is a financing item. So these are just detailed examples of what each of these means. So, and finally, coming to footnotes. Footnotes are basically explaining each of the financial statements. So balance sheet, income statement, and cash flow. They usually have just one-liners, right? So it might just say that the PP or property, plant, and equipment that a company owns is worth 100 crores. But what exactly is there within that? So PP could include building, plant and machinery, office equipment, computer equipment, furniture, etc. By just seeing the balance sheet, we wouldn't know what the split is. So the companies use footnotes to go deeper and explain the split of each of those line items. And footnotes are extremely important when you're analyzing any company. Whenever you go through a line item, don't just stop there. Scroll down, go to the footnotes, and read the footnotes. I will show you guys a sample annual report. Okay, before that, let's just complete MDA. MDA, as I mentioned, is where the executives of the company talk about what the plans of the company are for the next few years, the industry analysis, what risks the company could face moving forward, and importantly, what salaries are paid to the management, etc. All these are not included in MDA. The salary part is not included in MDA, but they are mentioned in other parts of the report. But MDA basically talks about where the company is heading in the future, what risks or concerns await the company, and how the industry is shaping up in the next few years. So these are the important statements that you guys need to look at whenever analyzing a company. Before I do a quick review of ratios, I'll just show you guys a balance sheet. Can you guys see? Are you guys still seeing the PPT, or can you see that I've switched the screen? Okay, I think you're still seeing the PPT. Okay, I'll just share it once again. Okay, so if you look at this, I've opened up the financial statements here, and this is of Maruti Suzuki. So if you go to the financial statement section, here you have different tabs on the top. If you click financial statements, it'll take you to the financial statements, right? So within financial statements, as I mentioned, there are three broad things: balance sheet, income statement, and cash flow statement. So first you have a couple of, auditor reports, etc. These are not important to us, but this is the core, right? This is what we actually want: balance sheet, statement of profit and loss. Statement of profit and loss is just another name for income statement. So here under balance sheet, you guys can see under non-current assets, the mentioned property, plant and equipment is 1,41,000 million, right? All these numbers are in millions. So just by looking at this one line item, you can't really say what Maruti Suzuki owns. It just says property, plant and equipment. So to understand this further, you go to the footnotes, and here they mention note number 4. So to understand what the split is within PPE, you scroll down to note number 4, right? You usually have to scroll down quite a bit, but it's totally worth it because you get to know what they hold. So here's the notes. Within PPE, this is the breakup that they have. So they have freehold land, which is basically land. Then they have buildings for, their car manufacturing services or service centers. All the buildings that they have is worth this much. Then plant and machinery to, make the cars and so on, right? So this is the split of PPE. So this is just an example of how you should read the line item on the balance sheet and then immediately scroll down to the notes to see what exactly is being spoken about. So coming back to the ratios, I know we have almost hit the 1 hour mark now. Guys, should I continue or should I wrap it up right now? Is it probably it's too late? A lot of you guys have to leave, I know. But what do you guys think? Are you guys okay for continue? Okay, everyone says continue. That's great to hear. Cool. Let's move on to financial ratios then. So what are financial ratios, right? So if, for example, right now we saw that Maruti's PP is about, I think it was 1.4 billion, let's say 1.4 billion rupees. So what exactly does that tell us? Let's say Maruti has 1.4 billion of assets of plant, property and equipment. And on the other hand, let's say Infosys has 2 billion. What exactly does that tell us about the companies? It just says that maybe Infosys is a bigger company than Maruti because they have more PPE, but that doesn't really tell us about how the company is performing. So there could be a very small company, which is, let's say even a startup, let's say BlueLearn itself, that could be doing much better operationally than, a big company like Maruti Suzuki. But just by looking at the PPE number or the assets number, we can't really get that info, right? Because that's just absolute numbers and it's not comparable. So what we do is we convert everything to a ratio form by dividing every number by a certain other number so that it becomes comparable. We'll go into detail about each of these. So broadly, there are 5 types of ratios: profitability, liquidity, leverage, operating, and valuation. So let's understand each of these in detail. So profitability ratios, as the name suggests, tells us about how profitable a company is. So how much money they're making given the resources they have. So looking at the 2 most important ones here, you have return on assets, which is basically net income divided by total assets. So this indicates that how the company is utilizing their assets to earn revenue, not revenue, but income, which is profits, right? After deducting the costs. So how well the company is able to utilize its assets. So this normalizes the value, right? For example, let's say Maruti Suzuki is earning 1 crore out of the 10 crores worth assets. So that gives them a 10% return on assets. Whereas Infosys could be earning 2 crores, but with the same 10 crore of assets. That gives them 20% return on assets. So this indicates that Infosys is able to use their assets in a better way than Maruti Suzuki to earn money. So this becomes a direct comparison factor, right? You can directly now say that Infosys is doing better than Maruti Suzuki. Before we just had the absolute numbers and we couldn't really gauge much except for the size of the company. But now we know that Infosys is doing better and is able to utilize their assets better. Similarly, net profit margin is the net income by revenue. So let's say Tata Motors has a revenue of 1 crore, but out of that, the net income, the profit after deducting all the different costs is only 20 lakh. So that shows that net profit margin is 20%. And I think, those of you who've been following Shark Tank, there was a lot spoken about gross margin, net margin. So this is where it comes from. Gross margin is basically the gross profit which you spoke about divided by revenue, whereas net profit margin is the net income, the final profit number divided by revenue. So don't worry too much about the formula itself, or you guys will get used to it. For now, just focus on understanding how these ratios help us analyze the performance of a company. Moving on to liquidity ratios, especially in recent times, liquidity ratios have become very important. So what do they mean, right? So liquidity ratios are those which gives us information of how much cash or how much ability a company has to remain solvent. So let's say there's a company with a lot of debt repayments coming up, but they don't have the cash to make those payments. Then the company will go bankrupt, right? Because those who have lent the money will take over the company because they're not paid the lenders back. So liquidity ratios became very important, especially during COVID, when the businesses started shutting down because of lockdowns. So that time it was very important as to how much cash the company already has with it, which it can use to survive the pandemic. Because obviously they couldn't generate more money because of the lockdowns. So all that matters was what they already had. So liquidity ratios are very important, especially in crisis situations like this, or the COVID, the 2008 financial crisis, or if the war right now between Ukraine and Russia blows up, liquidity becomes a very important aspect. So to assess liquidity, we have two important ratios. One is current ratio, which is current assets by current liabilities. So current assets, as we spoke about, are those investments that you have or those resources that you have that could generate potential benefit in a short term, right, within 1 year. And current liabilities are same, the obligations that you need to return or the favors you need to return within 1 year. So can you guys tell me what is a good current ratio to have? So if a company has a current ratio of less than 1, is it a positive thing or a negative thing? Negative, right? Absolutely, yeah. Everyone's got it right. Negative is right because they have more obligations to fulfill than the resources they even have. So they won't be able to fulfill the obligations within the next year unless something major happens or they get more amount of cash with them. So less than 1 ratio is most times a bad thing. In fact, all times. It must be 2:1. Janu, yeah, 2:1 is a fair number to use, but that will vary depending on the industry. For example, the IT industry, which has so varying on industries, right? So the auto industry might have different current ratios, IT might have different. So in those cases, you need to look at within the industry what ratio a company has. So that will give you a better understanding of where the company is currently positioned. So if you compare across industries, let's say Infosys has a current ratio of 2, but Maruti Suzuki has a current ratio of 1.5. That doesn't necessarily say Infosys is performing better than Maruti Suzuki. You need to then look at within the industry what's happening. So let's say within the IT industry, Infosys has current ratio of 2, but TCS has a current ratio only of 1.5. Now you can directly say that yes, Infosys is performing better than TCS because they are in the same industry. And despite being the same industry, Infosys is doing much better. So it's always helpful to compare within industries. So whenever using ratios, make sure to compare across companies, within the same industry. And the cash ratio is again similar. So current assets include certain things which aren't immediately able to convert to cash. So for example, if you have inventories, let's say I'm a retailer, let's say I'm Walmart, and I have a lot of inventory of, let's say, biscuit packets with me remaining. So I can't immediately convert this to cash within the next few days or few months, right? I need to find people who need to buy biscuits, and then only I can sell it to them and make cash. So that's usually not a very reliable thing to have. Inventory is not very reliable thing in a short-term crisis. So in such cases, you use the cash ratio, where you see what cash and cash equivalents you have, which you can immediately convert to cash. For example, if you have invested in Apple stocks, that is something which is very liquid, right? In the stock market, at any given point, there'll be millions of people willing to buy Apple shares. So this is something you can immediately convert to cash, and which could, help you out in a crisis situation. So all these are considered in cash ratios. Moving on to leverage ratios, this gives you an indication of how much debt or leverage a company has. So we spoke about debt previously as well. It's the amount of borrowing that the company undertakes, right? So if company borrows, let's say, X amount of money from the bank, is that a good thing or bad thing for the company? Just by knowing that it's borrowed, let's say 100 crores from the bank, doesn't necessarily say that, it's a good thing or a bad thing. We also need to know what the size of the company is to make sense of these, the absolute 10 crores of borrowing. So let's say there's a company which is which has assets of 100 crores and they take a 1 crore debt. So that's only a debt to asset ratio of only 1%, right? 1 crore for assets of 100 crores. That's a very small number. Whereas let's say there's a company which has total assets of only 2 crores and they take up a 1 crore debt. So that's a 50% debt to asset. So just by looking at the 1 crore debt figure, we can't really say whether it's a good thing or bad thing for the company. So we need something to compare it with, and total assets is something which is generally used. So again, even just by looking at debt to assets, we can't really say whether it's a good thing or bad thing for a company, because some companies might be running on debt. They might, taking the debt might help them achieve great things in the future. But usually the higher the debt to asset, it is a negative sign, because if a company has a lot of debt, it also means they have a lot of obligations to fulfill in the future. And they can't only focus on their operations. Because just imagine ourselves, right? If we have a loan on our name, at every point in life, whenever we get a salary, it's constantly nagging our head that, okay, I have to pay back this amount of loan, I have to pay this amount of interest. You can't really focus all that money that you get on doing the things that you actually are interested or want to do. For example, travel. You can't use the entire amount for traveling, right? Because there is some amount of loan that you need to pay back. Same way for the companies, because of the debt that they have and because of the interest that they keep having to keep pay, because of the interest they have to keep paying, what happens is they can't focus on their core business. They constantly have to think about repaying this interest, repaying the debt, and that takes away the focus from their core business. So that's why generally having a higher debt to assets is a negative feature for the company. And debt to equity is similar to debt to assets. It's just that you're comparing it with the shareholders' equity instead of total assets. So don't worry about the exact formulas. You guys will learn this later. For now, just focus on understanding the essence of what it means. Moving to operating or efficiency ratios, this is about how efficient a company is in its operations. And usually these ratios are used for companies which have a lot of inventories. For example, as I said, Walmart, how quickly are they able to sell their inventory? So at least for this case, don't look at the formulas. It's difficult to understand. You require more, like it'll take time to understand. So I'll just explain in brief what it means. So if Walmart, let's say, has inventories of 1 crore right now, and over the course of the entire year, they make sales of 10 crores. It means that they've sold their inventory 10 times over, right? The inventory, whatever they had 1 crore, they've sold it. They got fresh inventory of 1 crore, sold it, got fresh inventory, sold it. They did this 10 times to get the 10 crore revenue in the year. So it shows that within 1 year, Walmart is able to replenish its inventory 10 times. And let's take a competitor. You can assume Big Bazaar. So let's say Big Bazaar was only able to, replenish its inventory 5 times. So instead of getting a 10 crore revenue, let's say they got only 5 crores and the inventory remains 1 crore. So they were able to, replenish the inventory and sell it only 5 times. That shows that they weren't as efficient as Walmart in selling their inventory. So this directly indicates that, Walmart is doing a better job at shuffling their inventories. And obviously, And here you need to keep in mind that a very low or very high inventory turnover ratio could be a problem. Okay, forget inventory turnover ratio. Just think about the 10x replenishing that I just said. If let's say a company is taking too long to replenish it over the year, they're only refreshing their inventory one time. That shows that they're not doing a good job selling or marketing the products. But if the inventory is getting depleted very frequently, it could also mean that they're not maintaining appropriate amount of inventory. So this could be a potential problem, especially for automobile companies. Going back to Tata Motors, let's say they got a lot of orders and the inventory gets depleted very early on in the year. So for the new orders that they get, the waiting time will be extremely high because their inventory is deplenished. They need to again manufacture the cars, push them to inventory, and then sell them to the customers. So because of that, what happens is the wait time increases, and obviously as the wait time increases, people are not happy. So this is how you can look at efficiency or operating ratios. Finally, valuation ratios. These are what we as investors can directly have an impact on, because all the ratios I mentioned till now are how the company operates and how the company's operations are and how it handles itself. But valuation ratios are where we as investors come into picture. So most of these ratios involve the price of a stock, and the price of a stock is something we as investors drive, right? It can be driving it up or driving it down. We have a direct say in that. So this gives us a measure of how expensive or cheap a company is. By just looking at the stock price, or let's say MRF, it's usually a very expensive stock. Let's say the stock price of MRF is 70,000 rupees, but the stock price of Maruti is only 10,000 rupees. You can't say that MRF is more, a more expensive investment than Maruti. Yes, in terms of face value, it's more expensive, but in terms of the value you're getting, is it actually more expensive? So to figure that out, you use price to earnings ratio. So the price of a stock, if you divide by the earnings per share, let's say MRF is making, so let's, for calculation ease, let's assume MRF has a stock price of 1 lakh, but the earnings per share of MRF is 50,000. So for every 50,000 earnings per share, you're paying 1 lakh rupees for that share. So the P by E ratio is 2. Whereas on the other hand, if you look at Maruti, let's say they have a stock price of 10,000, but the earnings they're able to generate per share is only 1,000. So you are paying 10 times the earnings. So that's a 10x P by E. So now this gives you a better picture, right? Because for 1 rupee of earnings in Maruti, you're paying 10 times more, which is 10x. So you're paying 10 rupees for 1 rupee of earnings. Whereas in MRF, you're paying only 2 rupees for the 1 rupee of earnings. So now you get a better, judgment of which is more value, which is giving you more value. MRF obviously is giving you more value because you're getting more, earnings per share for a lesser price that you're paying. So with this, it becomes easier to compare across companies. And again, here also it's important to compare within industry. Right now, I just took a example of not the same industry to just give you guys a picture, but different industries have different P by E ratios. So it's very important to compare within industries. So this mostly covers all the different types of ratios. And finally, how do you make use of financial ratios? So there are two types of analysis that you can do: cross-sectional and longitudinal. So cross-sectional is what I've been giving examples of all the way along, where you compare the financials or ratios of one company with those of another company. So this is cross-sectional. Within the industry, you're comparing how one company is performing compared to another. And again, as I mentioned, please keep in mind to do this within the industry because that's always a better measure. And then you have longitudinal analysis, which is also very important. So to judge how a company has improved its performance over the years it's been operating, you use longitudinal analysis. So let's say right now the net profit margin of MRF is 30%, but 5 years back net profit margin was only 20%. It shows that over the last 5 years, there is something that MRF has done to improve its net profit margin, improve its profitability. So it shows in a way that MRF is heading in the right direction. So this is what longitudinal analysis is, where you compare the present performance of a company with the past performance of the same company. So these are the two different types of analysis that you can do. So that mostly covers my part for today. This is just an example of screener.com, where you can see ICICI and Axis Bank and how their P/Bs are different. So this is what I was mentioning within the industry. Within the banking industry, you see most of them are within the 20s, but Axis has a P/E of 62, which is extremely high. It shows that Axis Bank is much more expensive than the other companies. Just a quick question for you guys. Because it has a high P/E, what does it mean? Does it mean it's a good company, or does it mean it's a bad company? Bad, overvalued, right? So saying bad or good is not the right way to classify. Overvalued was a better way to put it. What it could also mean is Axis Bank is fundamentally a good company, which is why a lot of people want to invest in Axis Bank, which is why the price of the stock has gone up. And along with it, the P/E has also gone up. So it in a way shows that Axis Bank is actually a good company, but because of so much interest in the stock, it's gone to a stage where it's become extremely expensive compared to its peers. So as Rohit said, it's a good company, but overvalued. Yeah, sort of, I asked bad or good, but just saying that, bad or good, we can't really say just by looking at one number. Cool. So that was my presentation for today. I can just take you through the screener example once. I'll just show you how you guys can use screener. Screener is a very important tool when it comes to financial analysis. So let me just show you how to use screener. So this is the screener website. It's just screener.in. Just type it on Google. You'll open the website and a search page will open and you can type the stock that you want to look at. So I've typed in Maruti Suzuki. So in the home page itself, it gives you so much information about the stock. And obviously you can edit it, add whatever you want. I have added my own stuff here. So it tells you the market cap. Don't worry about what that is. Then tells you the stock price, book value, how much dividend it's paying, how much debt it has, etc. So if you scroll down, you get a chart which looks at the stock price. You can see how the P/E ratio has changed. And over the last couple of years, the P/E has been on an uptrend, which shows that the stock is becoming more and more expensive. And finally, the most useful aspect is this, where you have a peer comparison. It's not showing all the peers here. So let's look at HCL Tech, which is IT company. So here you see all the big tech firms in India, TCS, Infosys, Wipro, and in one table, you're able to compare them. So you can see the P/E of HCL compared to its peers. You can see how much debt it has compared to its peers. And you can directly make certain conclusions, right? If HCL has lesser amount of debt to equity compared to its peers, it clearly shows that in terms of leverage, it's doing a much better job than other IT companies in India. So this is what you can use to compare between companies. Obviously, today was just a brief of what financial statements are, what ratios are. To understand how ratios actually show clear-cut information about the company, you'll have to dive deep into each ratio, how they're calculated, and what it means. This is probably the next advanced step which you guys can, do on your part after today. And Screener also has briefs of the P&L statement, balance sheet, etc. So you guys can use this. Don't put your weight behind the numbers. Sometimes these numbers are not really exactly right. They do differ from the balance sheets in some cases, but I'd suggest that you use Screener for the peer comparison part. It's extremely helpful when you want to identify within an industry which stock to buy. For example, let's say moving forward, as I was talking, the electric vehicle industry is set to do well, right? So battery manufacturers are going to have a good time. So within the battery manufacturing space, if you want to decide which company to buy, that's when you go to any battery manufacturer. Let's just go to Amara Raja Batteries. and then you see how it's doing compared to its peers, and then you can decide whether it's a good investment or not. So this is how you would use Screener. It's a very important tool, so make sure you guys start using it for your analysis. So that's it from my side, guys. Thank you so much. I know I've exceeded by quite some time, but thank you for sticking on. Now I'll be happy to take any questions from you guys.
Hey guys, we can take maybe one question or two now. So if you have any questions, you can raise your hand and I'll let you on.
How to get PPT? I'll share it after the session. And
Hi Shivam, you can unmute your mic now.
yeah, ticker tape again. Yeah, Rohit, ticker tape is a very good tool as well. So you guys can use ticker tape. So screener, ticker tape, trend line. These are three good tools that you can use for your analysis. Yeah, Rohit, sure. We can connect on LinkedIn. Feel free to, or I also leave my contact details in the chat for you guys. You can feel free to reach out to me. And LinkedIn also, yeah, my name is just Rohan Kishore. You can find me on LinkedIn.
Yeah, hello, I'm audible.
Yeah, hi. Hi, Shwan.
Yeah, hello. So currently I'm pursuing my BVIT degree from some college and I want to get into investment banking and I'm in my second year. Can you tell me what kind of certification I do?
In terms of so see, for any finance role, I would say the first thing you guys should do is learn the basics. So today I think was just a start for you guys. Once you guys, start reading the financial statements by yourselves and understand them deeper, that's the most fundamental and most important thing for you guys to move into the finance industry, be it investment banking, be it equity research, be it anything. So that's the basic thing you guys should be doing. Coming to investment banking specifics, look, to be honest, I didn't really study anything very specific to investment banking. It was mostly building a solid understanding of the fundamentals of finance. So understanding the three different financial statements, the nitty-gritties of them, how they function. In terms of certifications, there are a lot of courses online up for these, not specific to IB, but to finance in general, like financial statement analysis. You have portfolio management. So these courses, though not directly relevant to IB, they definitely give you a very good understanding of the overall finance space. So I would suggest you guys, go through those first, and later on there are specific. So to be honest, there's no cut clear cut path to get into IB. There's no specific courses that you need to do, because most of the work in IB is about the financial knowledge that you have about the statements. So having a very solid understanding of those is the key to doing well in IB. So I would suggest build a strong base in that, and after that is just networking and the opportunities you get, or the resume you build. So that is very important in industries like IB and consulting. You need to have a really strong profile, a strong resume, good experience in the finance industry. So try to get internships within finance. You can reach out to startups on LinkedIn for the same. So yeah, to sum it up, one, build a
So
strong
thank you.
understanding of statements. Two, build a strong profile within finance.
I guess that's it.
Great.
If anyone has a question, oh, cool. So, Rohan, like, can you share the PPT with me?
Yeah, I'll do that. Is it okay if I send it to Chandan and he'll send it to you?
Sure, sure, sure. Yeah, yeah.
Cool. Yeah, I'll share it with him right now.
Great, great. Yeah. Whoever is in the audience, I'll just put it up in the announcement channel on our Discord server. You can download it from there.
Awesome. Then I guess we can put a wrap on today's session. Thank you so much for coming in and taking the session for us, Rohan. It was a really insightful session, and the audience really liked it. And if anyone has any queries, I'm sure they can connect with you after the session.
Yeah, for sure. Thank you so much, guys, for having me. It was great to have, an interactive audience and to get responses as quickly from you guys. So that makes it better for me as well. And yeah, post the session, feel free to reach out on LinkedIn, email, or my contact. I've put it up in the chat. So feel free to message me.
Awesome.
Great.
Thank you so much. Hope you all
Yeah.
have a great evening. Yeah, she can end
Yeah.
the live stream now.
Yeah. Thanks, Ron. It was really, brief and exhaustive. It was very good. Thank you for coming in and taking this session, giving us your time.
Anytime, guys, anytime. Thanks for having me. Thanks everyone for attending.
Thanks, everyone. We'll just end the session and we'll see you in like this whole week. There are many more events related to finance. So see you there. Good night. I'll just end the meet here. Thank you.
Bye bye.